Welcome to a Wiser Retirement Podcast. Before we get started with the episode, I wanted to let you know about a new free ebook available on our website. This ebook goes over the top reasons most financial plans fail and covers what a quality financial plan should consist of. The link to download Top Reasons Most Financial Plans Fail is listed in the episode notes. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, and joining me today is my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
So we've just hopefully are exiting this high inflation period of the last year and a half. And I thought it'd be a great time to kind of look back at the last year and a half and go, man, what could we have done perfectly in the portfolio, in a portfolio? It doesn't mean our portfolio or your portfolio as a listener, but just a portfolio. And what were the winners and what were the losers? It's complicated because this is Monday morning quarterbacking, right? It's like it's the incomplete pass to the wide receiver on the right when the guy, wide receiver on the left is wide open, but we maybe never looked that way because someone's about to tackle us, right?
We're about to get smashed.
Make it so easy, right?
Right.
I think that, and you have a lot of data there in front of you, but we'll start this way. So what got us to this high inflation period in the last year and a half?
Well, that is really kind of the main question, and economists are going to write about this and research this for years to come. It's going to be a classic example, that students are going to learn about for years and years and years. The classic definition of inflation is Milton Friedman had once said that inflation is purely a monetary phenomenon. Okay? It means it's always been with us. As long as there's been currency, there's been inflation. Okay? One of the causes of inflation is believed is the supply of money that's available for people to use in the currency system. We know that when COVID came along, in order to prop up the economy and to provide for people's lives so that they can continue to make their payments and live and buy their groceries and so on, the government is making tremendous amounts of cash available to its citizens, okay, and to corporations. So they flooded the market with cash. They increased the money reserve, it's called. That provided a stimulus for businesses to continue to pay employees, for people to continue to buy products and services, even though it was in a limited nature. And so that created also things that we refer to as the supply chain issues that we know existed. So we have these two things occurring at the same time. The money that's being flooded into the system. Some estimates are as high as $5 to $6 trillion of new cash that was put into the system.
And this is all because basically the government shut down the economy.
They shut down the economy, so we had to supply an artificial source of cash, of revenue, of cash flows to the system in order to make up for this cash flow that was being removed from the system by people not working, by people losing their jobs, by companies shutting down, in order to avoid the COVID disease. So as this money flowed into the system through government stimulus, it began sloshing around, the term is being used, and it just went to places that was easy for it to go. Asset prices were increased. Home values were increased. The Fed, the Federal Reserve Board, increased its balance sheet from $1 trillion historically to $5 or $6 trillion today. I mean, that increase in less than 12 months occurred. So all that money went back into the economy to be spent on goods and services that was being decreased at the same time through supply chain issues and government shutting down the economy. And so you have the classic example where you have too many dollars chasing too few
products.
That's right.
This is not, we could have a whole podcast on this with people who are more qualified, but I just wonder if the shutdown was even necessary. I just remember Merida Country Club, where I play golf. quiet little club, right? It had more member applications during that time period than ever before. Yet during my time on the Wellstar board here in Cobb County, we were seeing more people go hungry than ever before. And so it's created such a big disparity in wealth, but where people were doing really, really well, even better, because the type of industry that they were in were benefiting from that, right? And then you had the service industry just absolutely gutted of workers, which is what we saw in our economic data, where people were unemployment was greatly increasing. So I don't know. I think we just have to be very open-minded and very cautious. That, you think about even taking the shot, that it was supposed to be a vaccine, but I've never heard of a vaccine that you have to keep taking over and over, right? I mean, polio, you took one shot, you're done. We almost eradicated polio. I think there's a small case now. Somewhere in the world. I don't know. It was completely gone for, I feel like, a few quarters, and now it's come back. But anyway, I just think that we have to be careful about whenever we think something's absolute, that we have to question things now. So I think the next round, the people are going to think very differently about the government's reaction.
I think what, in the vernacular, I guess what we're saying is that there are unintended consequences to actions that are taken, such as shutting down an economy.
Right.
Right. And the unintended consequences in this case are you shut it down evenly, but it comes back unevenly.
Right.
Okay. Because it's not an even flow of goods and services back through, the supply chain itself. So we're learning more and more about the supply chain. And as a result, companies are bringing back, they're onshoring, quote, onshoring their supply chain back to the U.S., where they had, decentralized it for years because of cheap labor costs. But now we're realizing that indeed that may be cheaper, but it's very disruptive. Okay, so we're learning a lot about what occurred in a very short time. So the economy, that's like living in dog years, as we've referred to.
Right. Well, not only that, but you had so much stimulus that was put out there.
Right.
That I would argue that the stimulus benefited people very, very well, probably better than it should have. And now you have this whole mentality of, well, we need more.
Right.
We need more.
Well, that's the unintended consequence. We didn't know exactly how it would affect, asset prices,
right,
the stock market, real estate, home ownership,
worker behavior.
What is free money? I mean, essentially it was. I mean, when interest rates are 0 to 0.25%,
right,
that's effectively free money.
Well,
so how does that distort the way we spend money, the way corporations deploy capital in order to gain, return on invested capital?
It's been near 0 for almost a decade.
Right.
Which also has unintended consequences, which you're seeing some of that in the tech sector here recently, because growth is no longer costing you 0, right? Growth actually has some cost to it.
Yes, it does. We're going to talk a little bit about this. It's increasing duration.
We can get back on track. My thought is a lot of it was completely unnecessary, and I think a lot of it probably should be investigated to understand the real consequences. Rather than have cover-ups, we should understand medically what's happening to people because of what we had to do. What was required of us. I don't know. I think at this point, there's probably people who regretted not, or regretted taking the shot. And there's people who didn't take the shot who probably are unnecessarily persecuted. So it's probably time to just kind of put down the swords and reevaluate what happened. I think now it's a great time to do that. I know that there's been some talk about it, but I don't know that anyone's actually doing it other than a few,
so the question becomes, who has an incentive to do so?
Yeah, exactly.
That's right.
Yeah. Well, there's a huge incentive for Pfizer, and I don't want to pick on just Pfizer, but all 3 companies, there's a huge incentive for them to be selling shots, right? Huge incentive. I don't know. I think there were a lot of level-headed decisions made. Berry College is one of those. So that they were kind of a test study for the CDC up in Rome, because it's kind of a closed campus, and they determined that if you had COVID or if you had the shot within so many months, you were just as immune from getting it again or transferring it to others. So you could be on campus if you could prove you had it recently or you had the shot recently. Yeah. And then the effectiveness of both, obviously will wear off over time. Where other people took very different approaches, where if you want to leave your home, especially, we were fortunate to be living in the South. If you're in the Northeast, I don't think you could go to Madison Square Garden or anywhere else if you didn't have a shot. I have
family members all over the U.S., for example. So we're here in Georgia, Atlanta area.
Right.
I have family in the Chicago area. I have family out in Idaho and family out in Seattle, Washington. And all four three other places, experienced COVID very differently than we did here. They still have leftovers from it all, whereas we left it, we left it behind years
in 2020.
Exactly, pretty much.
Right.
So we lived a fairly normal life here, right. But they lived a very different life and had a very different experience.
Yeah.
In during this period.
I remember in
so they view it differently. Their perspective is completely different.
Late 2020. No, I guess it'd been 2021, early 2021. Took my son to a golf tournament in Pennsylvania. And Delta didn't even fly to Harrisburg anymore out of Atlanta. We had to go through Detroit. And we left Atlanta, bustling, traffic to the airport. We get to Harrisburg. The downtown was literally boarded up.
Yeah.
Like it was like a different country.
Right.
It's crazy.
Right.
My son was like, "Where is everybody?" I said, "Oh, they still have really strict COVID restrictions here."
Right. So these are all the unintended consequences of the shutdown, the stimulus that went into it. People were still able to live lives without having to go, and work, toil in some instances.
Yeah, but to be fair, though, that people were working from home. Sales still got, salespeople were still doing salespeople jobs, right? And they actually were making... They probably had more disposable income because they weren't moving around as much. There was nothing to spend money on. So all that was building up.
Well, there were some winners during all that period. And now those winners, our leadership will say, has changed as a result of inflation taking off and the reopening having occurred. So the winners back then were inside activities. Okay. What were some of those? Peloton, the biking company, was a winner. Netflix, people were buying movies like crazy because they were staying at home activities. So these
all
sort
the
of companies,
services,
just took off, and now that's kind of unwinding a bit as a result of the reopening. And now you have reopening, you have inflation, and you have rising interest rates, all kind of like a trifecta here. And as we saw it coming back in, the end of 2021, December-ish of 2021, we started having these conversations about what do we need to do? What do investors need to do? Where are the winners going to come from as we unwind this circumstance?
So it'd be interesting to see, data-wise. So you think about high inflation, everyone says to buy gold. And that didn't really play out. Why did you think gold didn't play out?
Well, gold is kind of the go-to currency, in the event of catastrophic periods.
Right.
Okay. So as we
went that period seemed pretty catastrophic.
It seemed catastrophic. But as we came out of it, we realized that the world it's not over. We didn't all go off the cliff.
Right.
It wasn't a great time. So, but then you have this combination of, we need to begin raising interest rates to offset inflation. So the dollar got stronger and stronger and stronger, became the currency that people wanted to invest back in. So now that we don't have a circumstance where, saying
the world's not coming to an end.
That's right. But, cash was trash. Remember that?
Oh, yeah.
Okay.
Right.
Now cash is king again.
Yeah.
Okay. So
ultimately,
strengthened.
If you have rising interest rates, you're going to have a stronger dollar.
Right.
That goes hand in hand, which therefore your gold investment would not do very well. And plus, we have a hard time with gold because it doesn't pay anything.
It has no cash flows.
It's like antique furniture.
Yeah. It's only as value what somebody else is willing to pay you.
Right.
But they want it now.
Exactly. So we can strike gold off the list. That didn't perform as well. Obviously, silver would be in the same category.
We looked at it as well.
Now, value stocks did really well, which are defined as companies that typically companies that. Let me rephrase that. Dividend paying stocks did well initially.
Okay, they did initially, but value stocks as a whole. Let's go back to that and revisit that. So you have growth, investors. You have value investors. So the value investors saw companies as potential investments that had real revenues, real capital, and those revenues were immediate. They didn't have to wait for them to come. Whereas on the growth investors, they're willing to wait for those revenues to come, even though they may not be here today, because the idea that they may come faster in the future. So that's technology, for example.
We should break that up, though. So in 2020, growth stocks did way better than value stocks.
That's right.
It was 21, growth stocks still continued. It was 2022 that we had the biggest drawdown in growth stocks, and value was in play. So 2020 actually ended up being a normal year. So I think what we're really talking about is the tail end of 21 through 22 when we saw the most inflation, where cash had been hoarded in 2020. In 2021, cash starts coming out to spend. Right. But then we're
still shut down in many locations.
Correct. But therefore there wasn't enough product to buy.
Right.
So all the cars had disappeared.
Right. The supply chain was tremendously inhibited.
We had computer chip issues.
I should say. Yeah.
Computer chip issues, partially because those come out of China, right?
Right.
And
that's one of the things that's being onshored.
Super shut down. Yeah, they had no problem shutting down the world. I don't think that there were chips coming out for a while. So
So technology is considered to have a longer duration, meaning that the payback period takes longer.
Right.
Well, back then, investors were willing to do that, but cost of money was like we talked about earlier, was almost free.
Correct.
So the discount rate that you apply when you're determining whether or not an investment is a good value or not was very low. So you're willing to wait longer for those streams of revenues to come. Whereas in value stocks and value investors, those streams of revenues are almost immediate.
Yep.
Okay. So the growth potential may not be as high.
Also, too, you probably saw a growth bubble. So you saw the big draw up of growth tech stocks in 2020, the stay-at-home stocks, right?
Stay-at-home stocks, consumer discretionary.
Through 21. Yeah. And then there was a bit of a bubble burst there. And so you give opportunity for value or dividend-focused plays to catch up.
Right. So that was a place to be, last year. One of the things that we saw coming is there's a security out there issued by the U.S. government, and that's Treasury Inflation Protected Securities, TIPS. Okay, they are designed to offset the effect of inflation by the value of the TIPS security, underlying security, increasing as inflation increased, and so it has a natural offset. So, and as it increased, the coupon remained the same, but on a larger base now. So you got paid a higher dividend at the same time, or interest rate. So TIPS are a place to have been during the past 2022 and going into 23. But right now the Fed has they've spent the entire year bringing to bear all the resources they can to stop inflation. So
TIPS are probably not the play anymore.
Right, that's over.
But just buying an outright commodity fund, because most commodity funds are going to be pretty heavy oil stocks. Obviously, commodity investments have done well in a rising inflationary period when it makes sense.
Right.
The only problem is you've probably been holding that commodity fund for the last 2 decades, waiting for this exact moment.
Right.
And you'd still been better off not holding the commodity fund and just holding the S&P 500 or something similar.
Commodities are things like oil. They're real assets they're referred to as. So it could be timber, it could be oil, it could be some gold, some silver, some precious metals, things of that nature, including TIPS are often found in real asset funds. And when people saw that in they own a home, for example, real estate is a real asset.
Correct.
Real estate assets were greatly inflated, have been. So commodity was a place to be during last year.
Yeah, the real estate in a portfolio makes sense too. The ETFs that are out there, the cap-weighted index funds, actually have less office space than you might think. They carry a lot of public storage, and
Right.
you think about public storage, that's not necessarily like the U-Haul place where you put your furniture. It could be part of that, but think of more like Amazon, where
these large distribution centers.
Correct.
Yes.
Yeah,
Yes.
that seems to be the top three holdings in most of the major real estate funds.
And this other one is the same thing, except dedicated to hardware for the internet.
Yeah, computers.
Okay?
Yeah,
Computer warehouses, so to speak. So server farms are sometimes referred to as. So these types of real estate are where the cash flows are, because whether the economy is good, bad, or indifferent,
right.
Okay, these things are filled with product, or resources, computers, et cetera.
And it's not so much that you're investing in those computers; you're investing in the
because they're paying rent.
The roof. They're paying. Yeah, you have good companies paying you rent every single month, and so I think that typically for ultra high net worth investors, I've always thought you should be carrying about a third, 33% of your assets in real estate, not including your primary home. And for that exact same reason, whether it be commercial or whether it be residential, vacation properties, people were going on vacation, the premiums went through the roof. You had that little drought there in 2020, but the recovery was real. Mm-hmm. And also too, I think real estate causes people to have better behavior, because you sit there and you look at your S&P 500 index fund and you're watching it drop. People can easily hit the computer button to go sell. But when it's your home, or not your primary home, but when it's in a real estate investment, it's a long process to sell a property.
And transaction costs are pretty high too.
Yes,
yeah,
that's right.
So
you have better behavior. You just ride it out and you keep generating that income.
I mean, just about everywhere you look, you see new apartment buildings going up.
Yes, there's a huge apartment shortage.
That's right.
Yeah.
There's a housing shortage because now housing costs more.
People can't afford the houses.
There you go.
It's a great time to be doing that as well. But you have to remember, you have to also, I don't want our listeners to be running out buying homes and real estate. You have to have the cash flow to be able to support those and maintain those as well. So typically we see that in higher net worth individuals doing real estate individually.
Direct real estate.
Correct.
Yeah.
What's interesting to me is, it used to be you buy a house at $80,000, you rent it out for $800 to $1,500 a month. The rent's still about that, maybe $1,200 to $1,500 a month, but you're paying almost $250,000, $300,000 for that same little tiny house, and the ROI just isn't there anymore. And so
that's right.
with local real estate, you just have to be very careful. But there are funds that allow you to access those type of investments. I like vacation rentals personally because I feel like you can manipulate the price by the week. And you also have the opportunity of using it with your own family, which creates a legacy, which we've talked about that a lot. Mm-hmm. But so real estate was a good investment the last few years. We know that it could have been in commodities that seemed to hold up pretty well to inflation, because you are essentially buying the problem. S&P 500 did what we expect it to do. It's going to fall out. Right. When you have at the beginning of rising interest rates.
So then you talk about the period before, the period during.
Yeah.
But what about the period afterwards? And
this is where stocks usually perform the best.
Stocks perform the best coming out. So this is now a very interesting time for us to see how the stocks in the portfolios will, in the S&P 500, for example, will behave in investor behavior towards this. So historically, stocks have done quite well after the inflationary period is over.
Yeah, I've seen the same research,
because we're going into a new cycle, cycle of the economic cycle. So it's a really very good time. What was interesting last year is that you had inflation, and then of course the Fed response to that is generally to raise interest rates. Well, we're raising interest rates from, as we talked about earlier, near zero, now up over 4.75%.
Right,
and so that really was detrimental to bond performance. Okay. But what that has done is, on the other side, we talked about now going forward, the bond yields are better than we've seen in decades. So we've created a tremendous opportunity to invest in bonds to gain yield. And as these these bond investments come back to par because now they're currently depressed, you're going to have capital gain at the same time.
Which, if you already own the bond, the best thing you can do is just reinvest those interest back into the fund so you can get new shares at that higher yield. That's how you get back to your break-even point the fastest. Because we all got hit pretty hard in bonds last year.
Right.
In fact,
but going forward, it's a good place to be.
Absolutely. But I want to try to think. So in a 60-40 portfolio, the chances of having stocks and bonds down the same.
Oh my goodness. It was the first time in 50 years that it has occurred.
Yeah, the first time. So there's all kinds of articles written about the 60 portfolio is dead and no one needs to invest this way. And they're all wrong. They're always wrong. 60-40 is the most, it'll always be. I mean, I've been doing this for 23 years.
It's the most picked on portfolio.
The 60-40 portfolio has been dead, buried, drug out to the backyard so many times, yet it still beats, 94% of active investors over 10 years, 98% over 20 years.
Right.
So yeah, people hate the winner, I guess is what it comes down to.
Yeah.
I mean, you can build a 60-40 portfolio now for 5 basis points, which is 0.05 of 1%.
It's
no transaction costs.
Yeah. And just let it sit.
Yeah, anybody's going to try to beat that.
Rebalance.
You got to overcome their fees first.
Yeah.
So it just doesn't make. Yeah, it's crazy.
Yeah.
But yeah, 60-40 portfolio will live. And but it just 2022 is not the year of that allocation for sure, or any allocation for that matter.
That part's true.
There's really no place.
What's
no place
also
to hide.
true is that we know that these cycles come along. And now we're moving out of that cycle, it appears.
Correct.
So we're glad to have it behind us and looking forward to better days ahead.
So that's why short-term bonds didn't save the day like it normally does. Right. Short-term treasuries usually save the day, but it didn't because you had rising interest rates.
At the same time.
Right. Dramatic.
Right.
Not a quarter or a half in the year. You're talking, 4 percentage points in a whole year.
Right. And they've calculated it's the equivalent of, generally, the Fed takes a slow approach,
right?
A patient approach. So they raise it quarter point each time. This is the equivalent of 17 1/4 point interest rate hikes. 17. Okay. Now they did it 7 times, but they raised it from a floor of almost 0. Okay. If interest rates were normalized and they were already around 4,
right,
and they raised it. That percent is very small relative from 0 to 1.
Correct.
And 1 to 2 and 2 to 3. Those rate increases as a percent are huge and had a dramatic effect on bond prices.
But it's a good thing. That's what we had to go through some pain. I think that pain's probably over.
Mm-hmm.
But it's a good thing because we shouldn't be having zero cost loans.
Right.
People who save well should be rewarded for saving. I had a client yesterday email me about a local bank that had a 5% 1-year CD. I hadn't seen that in a really long time. I think I went to look at our fixed income
screen on TD Ameritrade.
TD Ameritrade, mm-hmm. and or Amerischwab, as we call it now. 4.78, I think, was the 1 year.
Yeah,
and that's a brokerage CD.
Yeah,
that's really good.
That's very good for 1 year.
For 1 year.
Yeah.
So
we'll take that.
But that's normal. That should be normal.
Well, when there's free money, it causes it. It allows people to make stupid decisions with money.
True.
And when we're talking about businesses and we're investing in those businesses, business managers are allocating money that was free. And so we'll try this, or whatever the case may be. You apply an interest rate to that, and then they're a little bit more cautious
so
about
that means
that return on that investment.
That means your risk-free rate now is around 4.5%.
Mm-hmm.
So that means you can buy a 10-year treasury for around that amount, probably closer to 4 right now, I think.
Right.
4%. So it means if you're going to invest in stocks, you probably should be getting at least an 8 to 10%
rate of
return.
The risk-free premium is 4, let's say.
Right.
And so what's your risk premium? At least 4.
Correct.
So you're 8, and inflation target is 2.
Right.
So you want 2 more. So there you are. You're at 8 to 10%.
That's why I'm bullish stocks.
Yeah.
Just because companies have to generate that type of return in order to make it worth even investing. Otherwise, we just all go buy U.S. Treasuries and call it a day.
Right.
So it's this is all good in the end, and I guess it's a reaction to all the free money that was put into the system. You had numbers for that. How much did they put in? How much did the government put in?
They put in $5 to $6 trillion, depending on the estimates. But
so does that include the
M2? The money supply went from 15 trillion to 21 trillion.
$21 trillion.
Okay. And in the Federal Reserve balance sheet, it went from 1 billion up to almost 6 billion.
Yeah.
So that's 6 trillion. Those the numbers here.
So you have to go reset that.
You have to reset that. Now this money's there. How do they do it? They have to extract it from the money supply somehow. And this is what they're doing now by raising interest rates. And they're also, it's called running off the balance sheet by not reinvesting the income that's coming in on this portfolio that's being held, and literally allowing it to mature and not reinvesting the money either. So it's up to it's about $95 billion a month that they're trying to reduce
the money supply.
The money supply in
addition to raising interest rates.
Balance sheet, yeah.
So it's like 2x the interest rate.
That's right.
It's instead of going from 0 to 4.25, it's like going from 0 to 8.5.
Right. At the same time, they're taking money out of the system. Yeah.
So that's the shock that we're feeling in the money supply. I had a mortgage broker tell me recently that they're having a hard time getting Fannie and Freddie to take mortgage loans. Like they've really slowed down the mortgages that they're willing to accept.
Huh.
So that's a whole different ballgame when Fannie and Freddie are like, oh, no, we don't want to take on anymore.
Right.
So that's a whole nother shoe to fall. If that's an indicator of
that's the liquidity for mortgages. Yeah.
Right.
Right.
Exactly.
Yeah.
So in hindsight, the things that you thought would save you, short-term bonds, end up actually hurting you. Where should we have hidden in a crystal ball? Where's the place you would have hidden? Because a lot of people would say, well, we would have gone to cash, and cash is never an option. I mean, it is an option. It's not the best option.
Well, cash we hold on the side for emergency periods.
Yeah, but I'm talking about converting portfolios to cash.
Right.
Because now we're gambling. Now we're entering Vegas at this point.
Speculative. Okay. And so now we're speculating with cash, which is a very unusual thing.
Right.
And again, it's always that effectively is market timing. Okay. It's just a little bit longer period. So what do we always say about market timing? You can be right once.
Yeah.
But then you have to be right again later. So you actually have to be right twice in order to properly
you have to exit properly, and you have to enter back into the market properly.
That's right.
And what people always say is, well, it's falling, so I'm going to get out here, and if it falls further, then I won't participate in it. But if it comes back up to where I am today, then I'll invest the money back in. It doesn't work like that. First of all, my first example is the market often will be up. Its biggest up days are after its worst days. So if you say, okay, I'm getting off the ride today because I can't take the pain anymore, and then the next day the market can open up. So it could close, the S&P could close at 2,000. It could open up theoretically at 2,500. I mean, that'd be a big move for S&P, but, you get my point. Maybe the Dow is a better example because people follow the Dow more than do the S&P. But let's say it closed at 25,000. It can open up the next day at 26,000.
That's right.
You just missed the 1,000 points, and there's no way to capture that.
Right. That's absolutely correct. It's all based on investor interest at the open.
Correct.
Okay, so he can actually move before the market even opens, and it opens at a higher price than it closed yesterday.
And that could be your biggest day. And if you miss 8 of your biggest days, you're going to eliminate 3/4 of your rate of return
easily.
So for the year, so so going to Vegas with your portfolio money is not good. So we're not going to do a cash on, cash off strategy. That leads to destruction of a portfolio. So really, I mean, in a perfect vacuum, In 2021, after having a great year, you would have said, I'm going to move to value stocks or dividend stocks. I'm going to put in everything in commodities. And you would have had a great 2022. And who's going to do that?
Right.
You can't, that would have been a crazy decision to do at that particular time. So it's just really hard to even quarterback it into something that's realistic. So what we do is build a portfolio that can last in no matter what the environment is. And that's where diversification comes from. That's why I love the S&P 500. It's got 500 of the best companies in the world in it, and it's self-healing.
Well, the two best things that we can, as portfolio managers, can do is diversify the portfolio, and then allow time, of the investment to run its course. Okay, so literally, it's diversification over long periods of time is the best medicine, if you will, for inflation, economic downturn, and economic positive times to participate in the upside. So
that takes patience.
It does.
It's I think since the invention of the microwave, we've all lost our patience. We want it right away.
Maybe so.
But sometimes that souffle coming out of the oven that's baked for a while is better. It's always better than that microwave stuff, right? So that's how you have to think about it. You have to have patience. I've often thought that, we have finance degrees, but we really should have had a minor in psychology because it so much has to do with financial planning, is keeping people focused on the long term and focused on the prize at hand and not jumping ship.
People and money. It's all about people and money.
So we've talked about this before. Episode 45, that's a long time ago, Brad. We're in 149 now. Episode 45, we talked about inflation protecting your portfolio. That's a good listen. Portfolio diversification is important too. Episode 101 might be something you want to go back to. We also linked in our show notes to protecting your portfolio during a market downturn. And typically that's adding treasuries to the portfolio. But yeah, I don't know. Interesting chat. I just think that in the end, you have to build a portfolio that's focused long-term, and you look at what's happening around you in the short term, and you can make small adjustments. We made a few adjustments last year prior, even to what's happening, but they're small, minor tweaks. And it's kind of like driving down the road. You have a little wiggle room in your lane. If you go too far right, you get into that bumpy stuff. If you go too far left, you get into the reflectors, or into the other lane. So you have to make corrections every now and then, rebalancing the portfolio. Mm-hmm. Maybe there's a small segment that is more as a tactical or strategic play that you're making small adjustments to. But ultimately, it's maintaining diversification, focused on the long term, right?
Right. And allowing time to be your friend.
And keeping your costs low. Stop running after strategies that are driving up the cost of your portfolio, because ultimately the best active managers are also the most expensive. So it's like starting a race, and you get to start a mile ahead of them, right? And they have to do something great to get past that, right?
Yeah. And there may be times where they do, but then ultimately that their style falls out of favor.
Yeah.
So it's just
Oh yeah,
it's very true. They active managers can't adjust to the style of the market at any given time. They have their own bias.
Yeah, we had a prospect here recently that was really wrapped up in active strategies, and there was a firm in town that seemed to be beating the market every year for the last 3 or 4 years. And I'm like, yeah, that's what happens. Statistically, 3 or 4 years, they're going to win. But when it falls apart hard. And so you have to be careful of that, because that means over 20 years, 98% of active managers can't beat the S&P 500. That means there's 2% that are doing it. So how do you find that 2%?
Right.
It's really hard.
That's
really, really hard.
Due diligence is way beyond most individuals' capabilities.
And most likely, if you find it, you don't have access to it because it's a $30 million minimum.
Yeah.
All right. Well, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. Thanks, Brad. Talk to you next time.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and/or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.